and then we'll get things rolling. So again, thank you for joining me. Another round of the Sage Rutty Tele. Again, talking about why do we defer taxes. So today's agenda, why do we defer taxes in general? I want to talk about probably the most overlooked piece of the Roth versus pre-tax conversation. I know I talked about that a few episodes ago, but it's more in depth than most people give it credit. And I think that it's been really popular to go towards Roth. And I think that pre-tax doesn't get the respect it deserves. And then give a couple examples of when it doesn't work, when saving for the Roth or the pre-tax or both, when that doesn't make sense. If you don't know me already, my name is Craig Gingerich. I'm a certified financial planner, credit investment fiduciary, and a certified health savings advisor here at Sage Rutty. So why do we defer taxes, right? The thought process here is if I can avoid paying taxes right now and then pay them in retirement, it'll be to my advantage. And a lot of times people say, well, why bother? What's the difference here? Pay it now or pay it later. What difference does it make sense? Why do I put into the 401k versus just paying the taxes and dealing with it? I kind of absolute rule, right? I don't like to talk in absolutes, but one situation that definitely favors pre-tax, if you're planning on moving to a lower tax state in retirement, save pre-tax now. So many people that I talk to are like, I'm living in New York, I'm going to retire to Florida or Tennessee or literally any state besides California. Perfect. Go pre-tax right now. Do the traditional. Don't pay the taxes on it now, because when you take it out in retirement, it's not going to pay state income tax, right? Avoid 6.5% right now, pay 0 then. That's great tax strategy. A lot of people really love Roth accounts, love the idea of, okay, well, why would I do pre-tax if I could go to Roth and all of my growth is tax-free forever? So I mentioned at the start, the inspiration today was really from a conversation with a salesperson at one of our clients. He's been saving really aggressively. He and his wife have been saving aggressively. They're debt-free thanks to Dave Ramsey. They've gone through that program and eliminated all their debt, and now they're stashing away pretty significant sums of money, and that's fantastic. And he said, I'm following Dave Ramsey's advice. I'm doing 100% into Roth. I will not save anything pre-tax. And that made me a little bit worried. So just a little side note, Dave, if you are on the Tele today, I'm really glad you're able to join us. I appreciate that you've been able to help so many people, and I feel really bad having to tell you that you're wrong. And in this regard, I strongly believe that one of your pieces of advice is definitely wrong. So let's take a look at the fundamentals of tax first to understand why I completely disagree with Dave Ramsey on this one. So when thinking about taxes in the United States, we have marginal tax rates, which the best example I could think of is as you're kind of pouring down the wine glasses, if you're pouring down buckets, you have to fill the top one before you then move on to the next ones. So the first dollars that you earn are deductible, the standard deduction or itemized deduction, you pay 0%. Then you pay 10% on the next dollars. Then you pay 12% on the next, then 22, then 24, and eventually they just take an arm, then they take a leg, right? But it continues to progress forward. So not all of your dollars are subject to the same tax rate, right? Some pay 0, some pay 10, some pay 12, right? And continue to move forward from there. Looking at actual dollars and cents, if we look on here, and let's see if I can get the pen on here, right? If you're a married couple filing jointly, the first 0 to 24.8, you're paying 0%. That's your standard deduction. Then on the dollars in between that 24.8 and 44.5, you're paying 10%, then 12%, then 22. And so the thought process with a pre-tax account is it's going to give me a tax deduction. It's going to lower directly off my top bracket. So wherever you're falling on this chart, when you save pre-tax, you're saving at that rate, right? So if at a household you have 150 and you fall in this range and you take 20,000 into the 401k, all 20,000 of that would have paid 22% in taxes, right? So you're avoiding at your top rate right now. When you take it out in retirement, however, right, you still have to fill up each of those buckets, right? So I've avoided 22% on the way in, but taking it out, I'm going to have some pay at 0%, some pay at 10, some at 12, and then eventually some at 22 if I'm in that same bracket, right? So just going backwards to reiterate it, you're always deferring at your top rate, and when you're taking it out, you have then lower rates to fill up before you hit that top rate again, right? So I think a lot of people lose that in the mix, and they say, well, if I earn dollar for dollar the same in pre-tax and Roth, it's all net. Well, not necessarily, right? It's not all net, because you will have standard deduction, and you will have 10 and 12% brackets to fill up. So why do we defer? Avoid the top rate on all of those dollars, and some of them will pay zero, right? You've avoided 22, and some of them pay zero, or you're avoiding whatever your top rate is, and then some will pay zero. Some will pay 10, some will pay 12, some at 22, right? It will fill up the brackets, but it has to start from the bottom up. And so a lot of really big fans of Roth will, like Dave Ramsey, will say, well, what about the tax-free compounding interest? Tax-free compounding interest, how great is that? Well, it's fantastic. I don't want to say that Roths aren't great, but you need to understand exactly what you're trading off. So say that you want to save $10,000 for retirement. You earn 10 grand working at your job. If you save it pre-tax, all 10 goes in there. If you save it Roth, say you're in the 22% bracket and call it 7 for state, only 72 goes in, right? You give up maybe 28 of it in state taxes, and then 7,200 goes in instead of the full 10,000. If we take that and then compound it, right? Say you're saving that over 30 years. We compound it at the end of your working career when you're hitting retirement, and saving the $10,000 per year. If you did it pre-tax, you got 1.13. If you did it Roth, you have 815,000, right? Everyone still with me here? Use the exact same rate for both of them, right? They're compounding at the exact same rate. It's just with pre-tax, you have more dollars going in, but you owe some of that to the government, right? You're gonna have to pay taxes when it comes out. So thinking about it, if somebody said, would you rather have 1.1 million bucks, but you owe taxes on it? Or somebody said you can have 815, but it's all tax-free. Most people say, well, I'll have the tax-free, right? I know that it would end up netting more. Yes, if it's all taxed at once, absolutely. But remember, it's not all taxed at once, right? So while these 1.1 are pre-tax, it's not as if you're taking out 1.1 million bucks all at once, right? It's not all coming out and going to your taxes. So remember, of that 1.1, some pays 0, some pays 10, some pays 12. Even just looking at the standard deduction, if you have a 30-year retirement, look at the standard deduction for a married couple. That 30 years worth of standard deduction means $744,000 of what you're taking out of your account still hasn't paid taxes. Pre-tax dollars come out over 30 years. Almost $750,000 will have come out without paying taxes. That's crazy, right? And to go along with that, you also have a larger compounding base, right? So you have more dollars in there compounding. So while you're drawing a little bit more to cover the taxes, it's still leaving more in there to be compounding. So let's look at the numbers. Let's take a quick look at an example that I put together. So again, the 815 versus the 1.1 in the Roth situation. We'll say you are drawing $40,000 each year. In the pre-tax, let's say that you have to gross that up by 20%, right? So factor in state, factor in federal. 20% is definitely higher than what somebody spending 50 grand a year would be in. But to be on the conservative side, to be fair, I called it 20%, right? Now, if you continue to draw that amount and you increase it for inflation each year, right? So I need to draw out more to keep up with buying the same box of Cheerios every year. If you continue to inflate it, you continue to grow both of them at 5%, and you tax just the pre-tax side at 20%. When you factor it out over 29 years here, in the 29th year in the Roth account, you've run out of money. I think that's pretty crazy. I double and triple checked it just to be sure, right? So we're inflating the withdrawal amount on both sides by 2.5%. We're growing it by 5% every year. So you take this, subtract that, and then multiply it by 1.05. The tax rate we had to use on the pre-tax side is 20%. So to get 40, you need to take out 50. In year 29, your Roth account has run out of money, and your pre-tax account has $401,000 left in it. Isn't that just jaw-dropping? It's a little insane. And the reason here is each year when you're drawing out that 50 versus that 40, it's leaving a much larger sum of money to continue to grow and compound, right? Your 1.1 continues to outpace your withdrawal rate during the early years of your retirement because there's so much in there, right? Versus the Roth doesn't have that critical mass, excuse me, to be able to compound enough to withstand all of the growing withdrawals. So a little bit crazy. I know it. I was taken a little bit back by it, but I just don't want you to blanketly think Roth is always the answer, because it is definitely not the case. So when should you do Roth? What situations does this not make sense? If you're in a really low bracket right now, pay the low taxes. So if you are in the 10% or 12% bracket, do the Roth account. Odds are you're going to be in a higher bracket, whether you make more and retire in a higher bracket in retirement, or for the cynics in the room, if the government increases tax rates, right? So I'm in 12% right now, but the government's going to raise it to 18%. I'll pay taxes when I know that they're low. I'll pay 10 or 12 because historically those are so low. Down the road, likely it's going to be higher, and I still will have saved money doing the Roth. If you're restricted by the 401k max, right? So we talked about saving 10,000 in the 401k, how it's the equivalent of 10,000 or 7,500. If you're capped out at that 19.5, to do pre-tax, it takes 19.5 worth of dollars. To do Roth, it takes you 30,000. Why not get as much after-tax savings into the account as possible? If you're scared of future tax brackets, like I mentioned, if you think that the government's going to continue to increase tax brackets, do the Roth account. If you're trying to pass it down to beneficiaries, inheriting a Roth IRA is a lot better than inheriting a traditional. Same with 401ks. So if you're worried about passing away and leaving the money to your children, do a Roth. Or I'm a really big fan of having a mix. So personally, I do a mix. I do 8% pre-tax. I do 7% Roth. Gives me the flexibility at retirement to say, in the low tax brackets, I'm drawing from my pre-tax side, and the high tax brackets, I'm drawing from the Roth. So I wanted to add in one bonus piece of material that I've kind of worked on with a couple accountants, and I think it's pretty interesting. We've been calling it the New York State tax arbitrage. So in New York State, the first 20,000 of income from a qualified account is tax exempt that you draw after age 59 and a half. So say you retired, you're taking 20,000 a year from your 401k. That first 20,000 is exempt from New York State tax. So that kind of opens up this interesting window here. So say that you want to fund it into a traditional IRA. So I'm going to put $7,000 in a traditional IRA. When I do that, I get a $7,000 federal deduction and a $7,000 New York State deduction. If I then withdrew the exact same dollars from that exact same account, on that distribution, I'll have $7,000 additional federal income, right? So those wash. But at the New York State level, that exemption allows me to draw out the first 20,000 without having any New York State income tax, right? So in the end, you've netted out zero on the federal level, but you've netted out a $7,000 deduction at the state level. Pretty interesting, right? It's just an opportunity to be able to save money. It'd be great if it worked at the federal level. Working at the state level, most people are in the 6 to 6.5%. So on $7,000, it's saving you $450 in taxes. Nothing to write home about, but in Rochester, New York, you can do some damage with $450 of tax savings. So kind of an interesting technique. Again, it doesn't really cost you anything. You fund it in, you take it back out, and you've generated yourself a deduction. There are definitely some catches here to be able to qualify for it. You need to be over age 59 and a half to do it, right? So you need this part of things to come out without any penalty, or else that voids out your entire deduction. You need to have earned income. So in your household, you need to have some level of earned income coming in, what they call sweat of the brow wages or W-2 wages. So to be able to fund into the account, here, you need to have earned income. And then you also need to fall under the income limitations to do a deductible IRA. And so on an individual level, let me get the exact numbers here, make sure I'm giving you some factual information. If you're an individual, you need to be under $65,000 per year. If you're married at a household level, and you qualify for a 401k plan, you have to be under 104,000. Or if you're married and one of the two spouses does not have access to a 401k, you have to be under 196,000 of gross income. And that tends to be the piece where people fall into it. So, it works really well if someone is working part-time in retirement, if one spouse retires before the other spouse, or if you just have a spouse that doesn't work outside the home, take advantage of it, right? Direct tax savings available. So happy to take questions. Has my contact information here, my direct phone number, my email address is cgingerich@sageruddy, or even easier if you email 401k@sageruddy.com. It definitely makes it to me. Last and most importantly, as always, is thank you. Thank you for your time this afternoon. Thank you for the business and trust that you place with me and that you place with Sage Rutty. We certainly do not take that lightly. We know there's a lot of 401k providers out there, and we appreciate you continuing to choose to work with us. So I'm happy to field any questions. If you have them now, feel free to use the Q&A button. If not, I'm definitely happy to take direct individual questions. If you're kind of wondering, does that New York State arbitrage thing work for my situation? Send me an email. We'll have a 5-minute conversation. I can kind of give you some of the screening questions and say, hey, it works. You're about to save some taxes, or you're disqualified because of X, Y, or Z. So I don't see any Q&As popping in, so I'm going to let you all go. Again, I appreciate the business and trust and hope everyone has a very safe and happy Halloween.